Hello and welcome back to another session on the mortgage secondary market called Mortgage Secondary Market Players. The participants in the secondary mortgage today includes the lenders, investors, and the middleman. Each fulfills many different roles, including buying and selling the mortgages or acting as a middleman. Most participants are companies and not the individuals. The roles are not exclusive. Often, the participants in the mortgage market play more than one role simultaneously, buying and selling mortgages or acting in the capacity of a middleman. One loan may be sold several times from investor to investor. The secondary market consists of GSEs, government-sponsored entities, private investors, banks, financial institutions, insurance companies, pension funds, and the mortgages investment trust that buy and sell the mortgages as an income stream for the portfolio. So in order for the secondary market to function efficiently, the mortgage loans originated by the lenders need to be converted to securities which can be easily bought and sold. The process by which this is achieved is called as securitization. So the securitization is a process of creating, the pass-through, such as the mortgage pass-through security, by which the pooled assets become standard securities backed by those assets. Securitization also refers to the replacement of non-marketable loans and or the cash flows provided by the financial intermediaries with negotiable securities issued in the public capital markets. So the different players in the secondary market and the respective roles can be better understood if we discuss the structure of the securitization. So as you see in this infographics, we will first discuss the structure of the securitization, and then we will move on to discuss the roles of secondary market players. All right, so what is the structure of securitization? All right, though the process is complex, the securitization is designed simply to create the market linkages between the borrowers and the investors. So in order for the process to work, it must involve a true sale of the assets by the issuer. The entity that pools the loans in the preparation for structuring their cash flows into securities, so to a special purpose vehicles, SPV, which uses the funds raised by issuing the debt securities to fund the purchase. So a true sale is one that makes the assets, like the mortgages, bankruptcy remote from the securities issuer. That is, if the issuer were to fail, then its bankruptcy receiver would have no legal basis to attach or claim the assets back in the securities. So in order to avoid the double taxation, the SPV is typically structured as a trust, and the case of residential mortgages takes the specific form of real estate mortgage investment conduit, which is called as REMIC. Okay, so the issuers must perform the due diligence on the loans in the pool, checking for the fraud, faulty appraisals, violations of underwriting guidelines, and generally ensuring that the loans are originated in compliance with the applicable federal and state laws and are described in a fair and accurate manner. The issuer makes representations and the warranties to this effect in the securities documents. So the intensity of the due diligence function differs depending on the source of the loans and the origination channel. A retail lender pooling its own loans has devised the underlying standards under which the loans are originated by its own employees. Therefore, review will be limited to a sample of loans. In contrast, the quality of the loans in a pool assembled by a non-originating issuer that has purchased the loans from dozens or hundreds of different brokers will necessarily be uneven. Once the pool is assembled and due diligence performed on the loans, the preparations are made to transfer them to special purpose vehicles. This may be done by the issuer in the in-house or with the assistance of a separate investment banking organization that structures the cash flows into securities with the characteristics designed to meet the market demand. So the investment banker or the underwriter may also guarantee the sale of the securities. The proposed securities are described in an investor prospectus that provides summary information about the underlying loans and the details the characteristics of the securities to be issued, including the form and the extent of the credit enhancement, has to be applied. So the level of credit enhancement is determined by the credit rating agencies like Fitch Ratings, Moody's, and the Standard and Poor's. These are the agencies which perform the credit rating process. So based on the collateral quality, servicer rating, issuer reputation for the due diligence and other factors. Once the due diligence has been conducted, say for example on the pool, so the levels of enhancement determined and the ratings applied to the securities structured out of pool cash flows. The loans are transferred via true sale to the SPV. At this point, the underwriter has responsibility for placing the securities either privately or publicly with the investors. For public issues, subsequent trading is done over the counter through the market making dealers who hold the inventories and maintain the bid and ask the rates for the bonds. All right, so the final step in the process is the investor. There are a variety of investor types, and there are likewise a variety of motivations for investing in the mortgage-backed securities, which are often called as MBS. Some investors seek the cash inflows, while others use the mortgage securities for hedging. So mortgage-backed securities also have the different regulatory capital requirements than the old loans, making them more attractive to banks and thrifts. Okay, so let's learn about different players in the secondary market. So there are various different players in the secondary market. So mortgage originators, basically they are the commercial banks, thrifts, and mortgage brokers. Secondary market conduits are Fannie Mae, Freddie Mac, Ginnie Mae. Ginnie Mae is not exist right now. Okay, so the private investment conduits, and the investors are like the pension funds, insurance companies, commercial banks, thrifts, and the Fannie Mae. So if you look at the different players involved in the secondary market and what is the process involved and how the loan is transferred from one entity to the other entity. For example, the lender originates the loans and he sells the loans to the investor and the secondary market conduits. Some the originators, they sometimes hold their portfolios. They will not sell their loans. This secondary market conduits basically helps the loan originator to swap loans for the pass-throughs. And these secondary market conduits, again, they will sell those loans to the investors, because sometimes the originator also sells the loans directly to the investor. Sometimes the secondary market conduits will help the loan originator to sell the loans to the investors. And also the secondary market conduits pool loans into the MBS. So they would pool certain loans, like if the loan belongs to a prime mortgage, prime market, then they would pool those loans and attach it to the mortgage-backed securities. And these securities are again sold to MBS for the investors. This is about the different players in the secondary market entities. All right, let's learn about a few other players which play a very important role in the secondary market. So they are like government-sponsored enterprises. They're often called as GSEs. The majority of mortgage securities is issued and are guaranteed by an agency of the U.S. government. The Government National Mortgage Association, which was also called a Ginnie Mae because of the subprime crisis, that particular department of the government has shut down. So there are only two government-sponsored entities, such as the Federal National Mortgage Association, which is shortly called as Fannie Mae, and the Federal Home Loan Mortgage Corporation, which is called as Freddie Mac. These organizations are federally chartered agencies that support the secondary mortgage market through the mortgage purchase and securitization programs. Fannie Mae and Freddie Mac are privately owned and government-sponsored agencies that act as conduits, purchasing the mortgages and selling the securities backed by the mortgages. Okay, so let's learn about each one of them in details. So what does Fannie Mae do? So its purpose is to provide a secondary market for the mortgages by purchasing the HUD, FHA, VA, and conventional mortgages. Fannie Mae will not purchase any non-conventional mortgages like which are like non-conforming mortgages. The Fannie Mae replenishes lenders' funds to support additional mortgage lending. Fannie Mae purchase programs are like HUD, FHA loans, veteran administration loans, and regular conventional mortgages, first and second mortgages, fixed, adjustable, and graduated rate mortgages, and cooperative mortgages. Basically, we have learned about different type of mortgages which are based on the guarantee, which are based on the interest rate. So those kind of mortgages are bought by the Fannie Mae, which are guaranteed by the Fannie Mae. So Fannie Mae has a very rigid requirements for the standardized mortgages it buys. The parameters used by the Fannie Mae in evaluating the loans are mortgage type, loan balance, term, age, loan to value ratio, and the location. To do business with a Fannie Mae, the lenders must be approved sellers or servicers must meet the stated net worth requirements and must hold Fannie Mae stock. All right, let's learn about the Freddie Mac. Its original purpose was to provide a secondary market for savings and the loans to sell the mortgages they originated. Today, Freddie Mac helps maintain the secondary mortgage market by purchasing the HUD, FHA, VA, and conventional loans. As a loan purchaser, Freddie Mac has two major securities programs in which it packages the mortgages. So the first one is Standard Cash Program. So under this program, multiple lenders sell the Freddie Mac qualifying mortgages for the cash. Freddie Mac packages the loans into pass-through securities called participation certificates or PCs. All right, so the next the program which the Freddie Mac has is the Guarantor Swap program. Under this program, single lenders sell Freddie Mac qualifying loan pools in exchange of the participation certificates backed by same mortgages. In this transaction, no cash changes takes place. All right. So what is the another different players involved in the secondary market? So let's learn about the private conduits. As discussed in the section above, some private the institutions also package the loans and issue the securities. These securities are known as the private label mortgage securities. Private conduits buy non-conforming mortgages from the multiple lenders and package them into a saleable securities. In this particular capacity, they are middlemen between the loan originators and the investors. Private conduits are highly capitalized and willing and able to take the risk. Their high level of capitalization permits them to accumulate and fund large volumes of mortgages to securitize as MBS, like mortgage-backed securities. What they does is they purchase the mortgages that are geographically diverse. The existence of the conduits allows small lenders to participate in the secondary mortgage market that might not be able to otherwise. The conduits buy loans from small lenders at a discount to compensate for the risk they assume in buying the non-conforming loans and to offset the administrative cost associated with issuing the mortgage-backed securities. So as a result, small lenders are able to turn cash around quickly for continued lending. Because of the time and the expertise required to market private securities to the investors, conduits typically assign the task to investment bankers. Some of the popular private conduits are Sears, RAC, GMAC, and MGIC. All right, investors. Investors are the very important players in the secondary market. So investors purchase the mortgages in the secondary mortgage market seeking the long-term, large dollar investments. There are a variety of investor types and there are likewise a variety of motivations for investing in mortgage-backed securities and asset-backed securities, which are often called as MBS and ABS. Often investors such as the pension funds and the insurance companies are seeking to generate the cash inflows to match their own prospective cash outflows. Some use the mortgage securities to hedge other positions, especially around the interest rate risk. Others, such as the thrifts, may be looking for the assets more liquid than their investment alternatives. Thrifts will often swap loans to issuers in the exchange for the securities based on a pool formed from these same loans. Most investors are seeking primarily consistency between the expectations and the securities' actual performance through, though some are hoping to identify opportunities for the above market returns. Some investors are also concerned about the liquidity of the securities, that is, whether or not there is a market for them after their initial purchase from the underwriter. All right, lenders. Lenders occasionally purchase the mortgages, usually to diversify their portfolio or to meet the volume requirements to pool the mortgages to form the securities. That's all about secondary marketing players. I hope you enjoyed this session. I will see you in the next lecture. Thank you.